the US in the 1930s, a short, sharp shock, or Russia or Argentina, short, sharp shock and come out the other side, and you try to provide a safety net to deal with the social consequences of that. Now, thinking about those options, neither option is attractive, although I find myself drawn more towards the sort of long-term, slow growth Japanese one, just because of in terms of providing the needs of the media. So sort of, I feel that was a better model than the short, sharp crash. If you start having countries leaving the euro, you will have to have not humanitarian aid. You'll have to provide safety nets for the population, because the high levels of unemployment and so on would be quite devastating.
But that's already in existence. That's already happening. You've got soup kitchens in Athens. You've got, I mean, certainly within the southern states of Andalusia, so southern states of Spain, the safety net is required already. This is not. And actually, if you go back sort of to the 1950s in Spain, they had starvation rates, and they didn't have the economy. I think part of the issue is that the situation that we've got now is austerity isn't working, and for every reduction that you have, then actually, because there is no consumer-led investment, and that's actually really impacting any chance these countries have of getting out of the situation they're in.
Well, I mean, one of the things that is the eternal challenges that countries in the euro area have to face is that they don't have the full range of policy tools available at their disposal. So in countries that have their own currency, you can have a currency devaluation, which can then help sort of promote export growth. You can have a central bank that has a more accommodative monetary policy. Well, in the euro area, you don't have a currency that can depreciate in line with the needs of Greece or Italy or Spain, and so you have to go through an internal devaluation. And this is exceptionally painful. I mean, this basically means falling real wages. It addresses some of the competitiveness problems that some of these countries have experienced, but I don't think anyone trivializes the kind of human pain that it causes, and just a really fundamental readjustment of individual citizens' idea of what their future looked like. You talked about Greek pensioners earlier. I mean, to think about the citizens of Greece and how their idea of their future, whether they're 65 or 16, has had to fundamentally change in 2 years, is really quite shocking, and it's something that affects a generation.
What I was going to say, and talk about affecting the generation, if you look at sort of the levels of unemployed within the youth, I mean, people in this audience here, they have a greater level of opportunity. You're actually looking at students that are coming out of Spain, coming out of Greece. The stark reality is that they will not be getting a job, and that's a very heavy price to pay for a society as a whole.
Well, and it's also potentially a heavy price to pay for growth potential. I mean, if you think about the kind of productivity gains that individuals get, think about this on an individual level first, the way in which you become more productive by learning by doing. You have a whole generation where in Spain, 50% of them are not getting that boost to their careers, to their lifetime earnings. I mean, even if you look at the literature about young people graduating during periods of recession, so not the much deeper difficulties that countries like Greece are experiencing. There's a lot of this literature coming out of the US. It fundamentally affects lifetime earnings. And so there are consequences for what the spending power of consumers can be going forward.
And the tax revenues.
The tax revenues that accrue from those. And the kind of growth that you can expect to see again, because you have a labor force that hasn't accumulated some of the experience that generations before it have. And this is potentially a serious growth concern going forward. It's one of the big unknowns about the crisis is what this will do to growth potential, however much structural reform is actually enacted.
And Jen, would you be able to comment on what you've seen in Italy, or would you say very briefly about it?
So in Italy there's been a big change. It says that Berlusconi left and now we have Monti.
We might have Berlusconi again.
Berlusconi is very smart. That's we have to acknowledge that. I don't have any sympathy for it, by the way. But he's very smart in the sense that he knows very well that the longest Monty lasts, the better is for him. Because in his contingency, what Monty can do or what Monty is doing is actually not very popular. So that's what's happening. But the situation in Italy is a situation that is becoming more and more critical because, of course, Italy is also facing a situation of high interest rate, so it might follow Spain, especially if at some point it becomes obvious from the market perspective that the resources that are currently in place for Euro countries are no longer sufficient for bailing out or for bailing out Italy. So that's the problem that Italy is facing. I think Italy is essentially is a different with Spain. Is in better shape than Spain because Italy has a problem which is a political uncertainty problem, which has been there forever. And also has a high public debt in an environment that hasn't grown much in the past 10 years or so. So that's the situation. But from a fiscal point of view, at least the primary fiscal position of Italy is not as bad as Spain, or is not as bad as UK.
But that's interesting because you could have said that about Spain a few weeks ago. And I think this goes back to the initial debate. It's actually the contagion effect.
No, Spain has been. Spain has a big increase in public debt since 2000. Since the crisis essentially, and there's also a much worse primary deficit than Italy. So Spain is very similar to UK actually. There are of course some differences in terms of unemployment. There are differences in terms of which economy. The exposure of the economy to certain sectors. I think Spain has been growing a lot through the construction sector, while here it's been less dependent on the construction sector, here the UK economy, but there's not much differences, I would say, between Spain and UK from a fiscal point of view, for example.
The actual the structural differences in how people borrow money within Spain, and the fact that actually it's very difficult for people to default, isn't it, on their mortgages. And you're actually, even if you're unemployed, you are still liable if that's even if you die. Actually, it goes on to a member of your family, and it's much more complicated in terms of.
Well, you don't have the same sort of like Chapter 11 bankruptcy, whatever system. So that's why actually delinquencies in Spain look very low at the moment, because it's actually quite hard to it's not so easy to default on your mortgage. I think that's going to change and relatively rapidly. I think we might see a bit of a spike in delinquency because it needs to get easier. I think people need to get out of that get out of that situation. That is quite there's some quite big regional differences around Europe with UK being a bit more. So in the US it's very easy to default on anything. UK is slightly easier and it's not entirely less easy. And Spain is.
Okay, so going back to sort of the initial discussion, obviously investment in Europe is really important now, and at TAB we've recently conducted some research, and I spoke to a lot of European DMOs, the debt management officers, and they were saying that actually this sort of investor flight is becoming a huge problem for them now. And Michael, you mentioned about the fact that the Spanish bond issuance, that they struggled to get what they were looking for. How much of this is now down to the fact that the whole game plan changed with PSI and Greece?
It used to be the case we weren't able to track these things very closely, but we can now, with the sort of Target 2 system, I won't bore you with the details, we can now track sort of foreign flows of funds in national countries, and what you've seen is in a greatest extent in Ireland and Spain, to a lesser extent in Italy, that essentially foreign investors have vanished, and most of the bond market is being most of the government bond market is being bought by domestic sort of almost, you might think that if you're seeing your country struggle and 10-year yields are going to 7.5%, you might think, oh, perhaps we should sell some bonds. But actually, it's almost a sort of, there's two elements. One is if the country goes, we're in trouble anyway, so
We'll go down together.
we'll get out together. But it's also genuinely feeling that we're in this together, we need to support the government, and we're prepared to sort of bend a bit in order to make that work. So we've seen a sort of polarization of the issue, which essentially banks becoming more leveraged, more tied to their sovereigns, and you can't have a default of one without the other. You end up with a sort of situation in which they're mutually tied. You look at the correlation between financial bond markets and government bond markets is extremely strong, and becomes increasingly difficult to separate them. As I touched on earlier, Spain is sort of now in a situation in which some of the banks are starting to refuse or saying we can't take any more, we've got our own limits, we can't keep borrowing bonds. But interestingly, thinking about, if you think about, for instance, the difference between Spain and Italy, Italy's yields remain relatively low, and one of the reasons is that the net borrowing requirement of Italy is actually decreasing in 2012. It's been 50 billion less by the end of the year than it was at the beginning. So essentially, there's a net requirement. You think about coupons coming in and being reinvested, and bonds maturing and being reinvested. If banks, assuming that banks continue to roll over that money, the actual net amount of borrowing will decrease, which means that the reliance on foreign investors is much less. You don't have to leverage up your balance sheet by increasing the number of bonds you hold. So you're seeing in relatively favourable light, whereas Spain needs to borrow about 20 billion in the first half of 2012. It's got nothing left to borrow in the rest of 2012. But its banks are really filled to the funnels, and it's a question of whether they will persist in supporting their government.
But I think it's also important to not understate just the magnitude of the challenge that Italy faces. You've been talking about flows, but if you look on a stock basis, and if you go and look at the Banca d'Italia data and take out the S&P holdings, so the Securities Market Program holdings of the ECB, Italy, if you look on a stock basis, about half of Italian securities were held by foreign investors a year ago. Now, 36.5%, more or less. I mean, that is a huge change on a stock basis. And this is, and for a country that on an annual basis has to finance, has finance requirements of a roughly 25% of GDP, that's a big hole to fill. So I take your point about the net requirements falling, but even in that case, it is a very, very large group of investors that are having to be replaced in order to maintain access to liquidity for the sovereign.
And you've also seen the Italian bond yields creeping up again today, and I think this draws into, it's all well and good, you have these theories about how this will all work, but then the markets don't respond the way that the politicians want them to. Is this because the politicians don't get it, or, how should the markets be responding? And for example, short sell ban, that's another case in point.
Yeah, it's certainly not in that way, because you've had short sell bans before, and it's not made any blind bit of difference. With the short selling ban, you're only really banning a small group of investors anyway that do short selling. It doesn't mean that the institutions themselves that hold those stocks, those bonds, whatever it is, won't start to sell themselves. Things have deteriorated so much. Added to that, I think Spain got on the short selling ban for 3 months. Italy, I think, did it for 1 week for some financial institutions. That doesn't make any sense to me whatsoever, because it's not like saying 1 week or in 3 months things are going to be materially better, or at that point things won't go. And just almost going back to what are markets really reacting to? Well, I think they're just reacting to an unraveling of the whole system. Markets are made up of individuals, and individuals can see that actually what the Eurozone should have been doing 10, 20 years ago was setting up not just a more functioning union even without fiscal union. People talk about fiscal union. Well, investment is key, and you talk about investment in the sovereigns, investment in growth is really, really key as well. So, there was never any investment. Why won't German companies who are doing incredibly well invest in parts of Spain, help boost that unemployment, the unemployment problem, or try and solve it? It's largely because, education standards, they've not been standardised throughout the Eurozone since its creation. And, they are getting there now, but it's been an incredibly slow process. Added to that, the language barrier is huge, especially in somewhere like Spain, where levels of kind of English and German are fairly low, and you really do need to know those languages to operate in a global economy these days. So, I think the markets want, they don't just want free broad strokes anymore, because that's what we've been having. We need some kind of real detail, and to me, to help with this unemployment problem, I know I'm taking a comment with the question, but you actually need, why not have the EU Commissioner on languages to get everyone to the same standards? It renders the whole thing obsolete without it.
Well, I was going to say, so then we all have to be speaking German or
Well, we're quite lucky we speak English.
But rather than, we focus a lot, and I know we've got some questions coming through, but what I wanted to look at now, it's very easy to sit there and be critical and to play the blame game. But what other options are there? We talked about this earlier. Is there more that people could be doing? Well, clearly there is, but is it reasonable?
What do you mean by that?
Politicians.
I think the politicians better if they stop doing things. What they do so far is a disaster. I think the only one that can change the dynamic, at least calm the market in the short run, is the ECB. And the ECB should engage in, as I said before, in this unlimited commitment to intervene in the secondary market. That's what needs to be done. I think that's the only, for me, that's the only solution at this stage.
Which is actually what
I think there is no need to require more conditionality. What else can you require to this country? They are they implemented measures, austerity measures that have essentially backfired. Most of these countries are facing a recession. Italy will be in recession this year. There's a little growth prospect, and one thing that can be done, and probably it's too late also at this stage, beyond the intervention to calm financial market, is for the ECB to run ultra-loose monetary policy by committing to lower further rates and to keep rates low for a long period of time, in such a way that also the nominal exchange rate, so the euro would depreciate further, because now it's at a level that is too high for periphery countries. So that's, I think, what needs to be done. And this is the things that monetary policy could do if properly designed. But it's not. As I said, there's things that should have been done at least 1 year ago, and now it's becoming late because there are signs of slowdown. In Europe, it's obvious. In Germany, will also slow down in the next quarter and the following ones, and also outside Europe, because US recovery is not very strong, and China is also slowing as well. So that's.
So is the impact sort of outside European borders as well needs to be considered?
Yes, of course. Yes, of course. It's not just Europe itself. In itself, I think there is, you need to consider what's happening as a global economy, and things are not bright.
So, Michael, to bring us actually reiterated Gianluca's comments that the ECB needs to stand. Well, actually, it was thinly veiled. He didn't actually mention the ECB, but he was saying that somebody needs to stand behind the euro. Given the German reluctance, what do you do here?
I think cutting policy rates would help, but another 0.5% off will reduce the debt burden. I think it only goes so far. And one interesting new policy response that we've seen in the last year, I thought I might might just briefly touch on is the sort of concept of unfunded lending, which is sort of something new that we've not seen ever before, and I'm sort of interested to see how it's going to work. So essentially, we've had a few examples already. There's been some unfunded lending in Greece, part of PSI. There's some plan for Spain, for the rescue of Spanish banks. Let's take the one closest to home in the UK. So the scheme works like this. If it sounds, you have to sort of run strap on your extra brain at this point. It's a bit weird. But essentially, let's say the Royal Bank of Scotland lends some money to some UK businesses. Let's say it lends £10 million to various UK businesses. It takes those loans and it gives those loans to the Bank of England. The Bank of England in return, and it's sort of called a debt swap, that's the sort of technical term. It in return gives them some gilts. So now the Royal Bank of Scotland, instead of having those loans, has some gilts on its balance sheet. It takes those gilts and uses them as a form of financing. So it essentially gives the gilts in and gets cash back, and then it can do some more lending. So in that sort of complicated debt swap, which sort of you think, well, what's the impact in that? So essentially what happens is the debt burden in the UK hasn't increased. The Royal Bank of Scotland has now lent some more money. Essentially, the only sort of the biggest negative is that the Bank of England has taken some dodgy collateral and lent some money against it, which is sort of downside. That collateral might not be dodgy, but I mean it's dodgy than guilt. So that's the sort of transaction that you see. And now the Chancellor thinks it's going to build up a pot of 80 billion that is going to sort of be a boost to UK lending, or boost UK businesses that couldn't get lending otherwise. Now, so as I say, it's a new thing. I'm not quite sure how it's going to work. But here are the first thoughts that come to my head is that are there really sound businesses out there that can't get finance? Or is it actually the dodgy guys that probably shouldn't be lend money in the first place? So are we just attempting to re-inflate the bubble that we just deflated, but we re-inflated partially? 8 billion isn't a very large amount. We re-inflated partially to try and cushion the effects of the recession and provide a boost to the UK. So that's one example of a sort of an interesting sort of a way of doing it without raising debtors. Somehow it smells wrong, but it'd be interesting to see how that works out. It's quite likely we get something similar for the rescue of Spanish banks. Why? Because essentially the vehicles that are designed to rescue Spanish banks, the EFSF, you don't know who's going to be here, the EFSF or the ESM, these two sort of new European bodies that are like supranationals like the IMF or something that are come in and bail out. First, the idea was that Spain was going to bail out their own banks. That would end up actually increasing their debt. So now you've got ESM is going to bail out banks directly. What they're going to do is they're going to give them a piece of paper, stamp ESM bond. The bank takes that ESM bond, it gives it to the ECB, the ECB gives them cash. So now all of a sudden they've money out of nowhere. It's, as I say, this is new. This is something which you ask economists about, and they like some people feel value imposed, and think it's really good. So it's an interesting one. I think that sort of the markets will probably take a little time to chew that over. As I say, it hasn't really happened yet. It's been announced and talked about. People are still sort of fleshing it out. It's like they put out a straw man, and I'm waiting for everybody to sort of to destroy it or say it.
Can I just add one big point to that? Because surely, like, the caveat is that that Spanish sovereign will then benefit from that, because obviously the banks are so full of banks in Spain are so full of sovereign debt. And if that doesn't happen, or if something else happens, maybe in another part of the Eurozone, that whole kind of, that doesn't break the link at all, because they'll just be using that ECB cash to fund kind of losses lying elsewhere on their balance sheet.
Yeah. It's sort of how do you unwind it, isn't it? Which is also a problem with other types of stimulus like QE. So the difference between QE and LTRO is quite a subtle one as well, where in an LTRO you're planning to sterilise it, but Yeah, so I think it's so I think those are some very interesting new developments, and we'll have to wait and see it. And at least it's something. At least it's a start.
I'm very conscious of the time now. Do we have some questions that the audience would like to ask?
Okay, just in general, we have a very good number of questions coming in here, so we're happy about that. There's a few questions regarding the role of the ECB. Gianluca has mentioned it before, but only very shortly, and now it was mentioned again. But one person asks very plainly, has not the EU become a big Ponzi scheme, the ECB funds delivering cheap money to countries in troubles, etc.? And someone else asks, do you think the apocalypse is inevitable? The interest rates are historically low at 0.7% borrowing rate, 0% deficit rate. The ECB is running out of funds. EFSF fund is probably not enough. Then there's the ESM. And then there's maybe start with the ECB again.
The ECB is running a Ponzi scheme. How do we want to approach that one? That's really the LTRX.
I think you have to think about what are your choices now. First of all, there's nobody running the show. It's like being on a big horse. You're all clinging on to the side, and you're trying to steer it one way or the other. It's not like somebody's making decisions here. You've got a lot of people giving directions to the horse and it's playing that track. But the big Ponzi scheme comes from the idea that either you go all in and you say that we're going to have more Europe, we're going to have a federal Europe, we're going to have harmonise our tax rates, we're going to harmonise everything across Europe, or we're going to split it up and we're going to go back to having single currencies. And I think there's a realisation that there's not many middle grounds. It's quite hard to find a way in between. So the Ponzi scheme element is the all or nothing element. It's the only way we're going to solve this is what the market has been wanting to hear somehow, or wanting is this sort of unconditional guarantee. They want at the moment they feel there's a limit to European solidarity. They want that to be unconditional, and they want to get as close to unconditional as possible before they're willing to rally and buy Spanish bonds again, and so on. So
which is exactly Gianluca's comment about the ECB. That's what they need to be doing. So are we still going back to the square one though, where we all know what needs to happen, but given the intransigence of certain elements, is it possible? Is it feasible? I mean, the bottom line is, it seems to be a clear choice. We either go all in, or it's all out. So we talked about that before.
It's not necessarily that it's all in or the whole thing falls apart, but it's very clearly binary, and there's a cost either way. And particularly a cost for the strongest countries in Europe. I mean, it's very obvious that there is a very severe cost to be paid by Greece if it exits the euro. But certainly you have, the big unknown is just how big the cost is going to be for the financial sector, for the broader economy, the kind of instability that you would get when Spain and Italy lose access to markets. And would that actually prompt one of the events that politicians are trying very hard to avoid, which is some of these very large economies, which we've already talked about being a game changer, actually losing access to financing, market financing at least.
Did you have more questions?
Yeah.